Welcome everyone to our presentation. So we have done a group project on the topic optimum portfolio generation, and uh, we have divided this into different parts. Firstly, we have different investment options that we are going to explore in order to understand how the optimum portfolio generation page works. So let me first give a brief intro about uh, what optimum portfolio generation is. So basically, a portfolio means it's a mix of investments. So instead of investing in a um, single instrument like a share or a bond or a mutual fund or an FD, like any investment options, we consider a mix or a combination of one or more, two or more of these investments. So what happens is that when we combine two or more of investments, we get a higher return or balance of return with your risk tolerance. Let's just say a normal investor, a person like me, I have an amount I have kept aside as savings, and I have kept the amount as savings. Let's just say I have rupees 10,000 as savings, but I am willing to invest this amount and take a small amount of risk if I will be able to generate more than 10% return. So if I'm only investing in a fixed deposit that is offered by a bank or a post office, I would only get a net return of almost 6 to 7% uh, annual. That is maximum. But let's just say that I am willing to take some risk. So what I can do is I can invest in shares or mutual funds. But what happens is even though mutual funds and shares may offer us a greater returns, maybe between 10 to 20% or above 20%, there is considerable amount of risk here. So I might lose all my investments if the value of that mutual fund or share goes down in the market. So how will I how will I balance my risk? What if I want to earn a little more than a normal FD and maybe not so much returns as a normal stock like a 20 or 30%. I want to earn something in between these figures where I am willing to take some risk. So optimum portfolio generation page lets you create a mix of investments where I can invest and divide my total amount in hand into different investment options, and I'll be able to create a mix that would earn a better returns by balancing my uh, by considering my risk tolerance. So without further ado, I'll just uh, go to the presentation right now. So before explaining how the portfolio generation page works, I will be going through each of these investment options that we have considered for the mix in the optimum portfolio generation. So let's start with banks. As you know, banks are the safest ways that we can invest our savings and generate a small amount of return without having to take any risk. So banks and post office, etc., are said to be risk-free returns, and it is most popular among salaried individuals, where they want to retire and do not want to throw away their hard-earned money by taking a risk in any in other investment forms. So banks and post office offer a decent return without actually taking risk. So here what we have done is I can select what kind of banks I'm looking for. For example, if I only want to see nationalized banks, I can select nationalized banks. Or if I only want to see private banks, I can select private banks. So here, let's just say I'm trying to look into nationalized bank, and I'm going to select one of the banks here. Let's say I want to see the analysis of SBI, and here I can see a review of SBI. It's highly satisfied with bank service, and I can see the analysis of on deposits. So from 2020 to 2023, the deposits have been constantly rising. See, and I can choose different banks and see how the deposits. I think the figure mentioned this in growth. So deposits are always rising in case of banks because every individual prefers depositing their banks, and most popular banks will always keep having their deposit rising year by year. So this page lets you see the analysis here, and you can choose a bank and see the rating or a review here. This is what this page uh, shows. So let's move on to the next page. Here you can see it's a comparison of FD and RD of each banks. So firstly, we have to select what bank we want to see. We want to compare which bank's FD and RD returns. So I'm selecting, let's just say ICICI Bank. So here the visual gives me a list where I can see the maximum FD return and the number of days that I have to invest to get the maximum FD return that is offered by ICICI Bank. And similarly, I can see the maximum RD return and the maximum number of days I have to invest in order to earn the maximum return. So it is different for each bank, right? You can see for HDFC, in order to get in 7.25 FD return, I have to invest for 50 days, whereas for Canara Bank, it's similar, it's very similar. Yeah, for Bank of India, I have to invest, for almost 730 days to get a similar FD return. So here you can filter and choose which bank will give you the uh, highest return in the least number of days of investment. So it's a good analysis that lets you choose your banking partner and helps you take wise decision without having to having to invest your funds in idle banks like you can see, for example, we have got Bank of India. So let's just say, let's just move on to the next page. Here, yes, it's a selection page. A user or an investor needs to perform a few selections here in order to see this visual properly. So this page is the comparison of FT and RD returns. So what we have to do is I have to select a particular period. For example, I have, I want to invest 2 lakh rupees. Yeah. And for a period of, let's say, 600 days. So for almost, if I have almost 2 lakh amount with me and I am ready to invest it for a period of 600 days, uh, I can select each bank here and compare what uh, what amount will I receive after 600 days for the 2 lakh rupees. So here I'm selecting another bank. For example, if I'm selecting HDFC Bank, you can see for investing between uh, 540 and 629 days, I'll be able to generate a 7.25% of return and receive a close figure of 2 lakh 26,000 rupees as my future value of that investment. So this is what that page does. You can see the comparison of FD and RD. So let's just say I don't have this amount in bulk. So I don't have 2 lakh with me at present. But what RD does is I can divide this amount, I can deposit this amount monthly. So what I do is I have 2 lakh rupees, I don't have 2 lakh rupees with me, but instead of depositing 2 lakh at one time, I can divide 2 lakh by 12 months, and for each month I can uh, deposit that small figure and accumulate 2 lakh by the end of the year. So if I invest in a similar way in an RD, I will be getting a return of 2 lakh 12,000 instead of 2 lakh 26,000 in an FD. So you can see in every bank almost the FD uh, return amount is always greater than the RD return amount, because FD return amount, the interest is being calculated from day one on the bulk 2 lakh, whereas for RD, each amount is getting added only on a monthly basis. So the interest only gets added in periodic pay instead of from day one. So that is what the difference is. Uh, that is the cause of the difference here. So let's move on to the next page. It's a comparison of different post office schemes. Here you can see the minimum amount that you have to invest and maximum amount, and a small description about what the investment scheme is about. And here you will be able to see a comparison of different investments that we have seen here. Its return is the orange line. So return is in percentage, so 8.2 percentage for a period of 21 years. And you can see that at uh, this point is at maximum. We can see for senior citizen scheme, you will be able to uh, get a return of 8.2 percentage if you only invest for a period of 5 years. Of course, it's only available for senior citizens. You can see here the eligible group is only senior citizen. So yeah, it's logical that they will be able to give that kind of percentage for a period of 5 years. And similarly, Suganya Samriddhi account is also a unique scheme where it is only eligible for girl doctors, I think. Yeah. You can see the description here. And it's offering 8.2 uh, percentage of return for a maturity period of 21 years. So let's move on to the next final page of bank here. So this is a very important page. You can see as an individual investor, I would prefer to see this analysis. Um, yeah. So I need to select the principal amount. That is the amount that I have. So let's just say I have 1 lakh rupees now, and I expect in future that I will get 2 lakh rupees, and I'm willing to invest that for a period of let's just say 2 years, right? So 2 years means almost 730 days. Yeah. So as you can see that my expected rate of return is turning out to be 41 percentage. Okay, that is highly unrealistic for a bank FD. So here you can see that I won't be able to earn 2 lakh rupees by investing for 730 31 days. So you can see the maximum amount if I invest in a bank FD I can earn is 7.4 rate of return, and if I have to invest for a period of 444 days, and I have to invest it 2 times. For example, I have 1 lakh rupees now, and I have to invest it for 444 days. After the maturity period of 444 days, I have to again invest that matured amount at the same bank at the same for the same number of period in order to get the same return. So I will be able to get a return sum of 1,16,611. So it's highly unrealistic that I will be earning 2 lakh rupees. So let's just say I am willing to deposit for a period of 1,000 days. So yeah, still I won't be able to earn that figure because my expected rate is still too high at 28.52 percentage, and I have to invest it for a period of if I have to invest it for a period of 10 years to receive a double figure, then the figure will be 3650. Yeah. So if I have to invest this figure for 10 years, my expected rate is 7.12. And here you can see, yeah, I'll be able to, uh, yeah, I'll be able to receive a sum of 1,75,000 or 1,76,000 here from HDFC Bank. If I keep repeating my investment 8 times for a period of 450 days, I will get the final sum of 1,76,000 rupees, which is closer to 2 lakh rupees. So that's it about banks. And now let's move on to equity. Yes. So Equities are the most popularly known as shares or stocks. You might have heard about stock markets, market fall, market growth, etc. So these terms come from equity only. So here, what equity is most popular among uh, all those businesses, companies, uh, banks, etc. They invest their amounts in equity shares for higher growth. So investing in equity is much riskier, and uh, similarly, it reaps that kind of reward also. So you can see a brief description of equity here, and let's just move on to the pages. So here, this is an equity stock screener. Here you can individually select a segment first. For example, I'm selecting banking. You can see all the banking companies here that are selected for analysis, and you can see as an individual analysis of each of the stock, or I can directly choose the stock from the stock list. So let's just say I'm selecting Infosys. It's an IT company, so it's in the IT segment, and here I can the period I've selected is from 6 March to 6 March 23 to 5th March 24. That's almost a year. And here I can see the average close price. Average close price means the price at which you can buy this share in the national stock exchange or market. This is the price that's available for buying one share of Infosys. And here you can see the company's profit and the company's um, you can see the company's sorry. And here you can see the close price by date. This is the movement of the price that is happening from March to March 23 to March 24. And here you can see the price. It's very volatile, and it keeps on going up and down. But ultimately, it's in the rise by the end of March 24. So this is why we say investing in equity is risky, that because the market the price changes according to the market fluctuation. So it can sometimes generate a high return, or sometimes it can generate a negative return. So moving on to the next page, you can see once I've selected a stock in the um, equity screener, then the slicer automatically shows you the analysis in the second page, where it compares the risk of each stock and its daily rate of return. So yeah, you can see the analysis comparison, everything here, and the profit percentage, the PE ratio, the earnings per share. This page is typically you can see in any um, market websites that is available in India. So all the information we can get uh, from those websites as well. So it shows you the total trades that taken in a year, its net profit in amount, its total market capitalization. And yeah, you can, if you have any doubt regarding any terms here, you can just click on the information button and understand the description from this from the same. So let's move on to the next page here. So EQ calculator is a selection page where an investor has to select the amount he has in hand. Let's just say I have 1 lakh rupees with me. Yeah. So here it's a selection page. The equity calculator lets you enter uh, the investment amount that you have in hand. Let's just say I have rupees 1 lakh, and I'm willing to invest it for 100 days. And yeah, so for example, here I have taken Adani Green Energy. You can select the company which you want to invest in. So here I have selected Adani Green Energy, and average close price and its daily average return, everything is populated here. So based on all these figures, I will get the amount that I will be receiving after 99 days. That it's an estimate. It's not accurate exactly, but it's based on the past trend of the stock, and I can get a net return of 7,121 rupees by investing 99,000. That means almost 1 lakh, and I can generate a net percentage, a return percentage of 17.13 percentage from a period of 99 days. So if you remember from banks or post office, this amount I'm getting from just investing for 99 days. So that's why we are saying that stocks generate a higher return, but also pose a much higher risk than uh, a return like banks. So the total return after 98 days will be my figure and my balance amount. So this balance amount means that will be able to purchase shares based on this figure. So whatever I am dividing, so for example, I can buy 60 shares with 1 lakh rupees because of the average close price. So whatever the balance amount you can see will be populated here. And for each stock, I can see uh, this similar comparison. So moving on to the next slide, you can see here. Yeah, this is a comparison between the market and individual stock. So I have to select an individual stock here, and I can compare an individual market. For example, here I am selecting HDFC Bank, and HDFC Bank I am selecting the market to compare as Nifty 50. You can see HDFC Bank moves closely with Nifty 50 except for January 24. So this is a comparison of how an individual stock performs in parallel with how the market performs. So this way you can select different markets and see how the stock is moving. Is it performing better than the market, or it's performing below the market, or is it performing at par? So that is this page. And Nifty sector analysis also is very similar. Instead of taking index as Nifty 50 and Nifty mid cap on all these indexes, we use sectoral indexes. So you can select a Nifty auto for says comparison of all the automobile industry companies and banks for other banking companies. So this is that page. And finally, for IPO, IPO is usually the initial or the first step to get your company listed in the market. So initial IPO full form is initial public offering. You can see here in the information tab. So by giving an initial public offering, the uh, company offers uh, this much shares for an individual share and quotes their own price for the share. So you can see here this table shows the successful listing of companies. For example, here whatever is marked in green is a successful IPO, and whatever marked in red is a failed IPO. For example, if I take a green IPO here, Tata Tech success because the issue price quoted by the company is 500, whereas the IPO listed or the opening listed price, the first day in the market, the price quoted after uh, the individual investors or people traded in the market is almost 1,400. So this is a highly successful IPO. But you can see for LIC India, it's failed because the price quoted by company was 9.9, but by getting listed, it decreased to 867. So that is what this page is all about. Now let's move on to mutual funds. Yeah. So mutual funds are like a combination of shares only, but yeah, mutual fund are managed by expert fund managers, where they collect a pool of money from large number of individual investors, and they invest directly in shares or other instruments that pose a higher risk. But instead of directly uh, sharing the ownership of those shares with individual investors, they themselves issue a unit of their mutual fund, and that uh, mutual fund, the price of that mutual fund rises as per it rises in accordance with the investment. done with that pool of money rises. For example, let's say I am an individual investor and I don't have a large amount of money to directly invest in shares and create a portfolio of shares. So what I do is I buy mutual funds of a company, let's say Aditya Birla Mutual Fund, and Aditya Birla Mutual Fund collects small amounts for one unit, maybe 200, 300 per mutual fund, and they collect this amount from different individuals, investors like me, and they create a pool of money, and this pool of money is invested in individual shares, stocks, and gold, maybe different funds. And return generated by these investments are passed through to individual investors in form of dividends or capital. So moving on to the uh, first page. So mutual, you can see we have selected this much mutual fund for analysis. So here I can select which mutual fund that I want to select for analysis. So here I'm taking Franklin India ELSS fund, and here you can see how much uh, fund is allocated to equity, how much fund is allocated to debt, and other markets. So Franklin India ELSS fund is in equity linked savings scheme, and most of the amount is invested in equity only. And in equity, it is divided to large cap, small cap, mid cap, etc. A high portion of this amount is invested in large cap, and here it is the movement of uh, this particular mutual fund over 6 months. You can see the amount it's only keeping it keeps rising only. And yeah, so the AMU here you can see is the total pool of money that this mutual fund has. So it has almost 6,033 crores, and exit load, etc. is the fee that you have to pay to a mutual fund when you are redeeming the or selling the mutual funds. Expense ratio is the commission that you pay to the mutual fund manager for managing your funds. And this is a small. If you want to invest in lump sum, this is the minimum amount. And if you want to invest in SIP, this is the minimum amount. And average NAV of a mutual fund is almost 1,252 of this mutual fund. For buying one unit, you have to pay around 1,200. So before moving on, let me just explain what SIP is. You can see in the information button as well. So its function is similar to a current deposit. Instead of depositing a bulk amount, you can choose a systematic investment plan where you will be able to deposit a small amount periodically. So that would allow you to uh, create a large investment by the time you retire. So usually most individuals chooses systematic investment plans. Salaried individuals choose systematic investment plans. So they can grow their fund in a repeated systematic. So let's move on to the next page here. So once I've selected my fund name, you can see which all sectors my mutual fund Franklin India ELSS is uh, allocating its fund. And you can see different measures, financial measures, top holdings of this mutual fund, and you can see for other investments as well, other mutual funds as well, which all companies they mainly invest, and which all sectors they mainly allocate their fund. So if an individual investor is educated enough, they can directly go and invest in these individual shares and create a portfolio that moves similar to this mutual fund. But uh, an individual might not have enough money to buy all these stocks because these are high price stocks. So instead, you can just buy one unit of mutual fund, and your amount the risk exposure of your amount gets balanced because of exposure to all these sectors. So market may even if one market goes down, you might not your mutual fund investment might not get affected by it. So moving on to the next page, here you can see uh, the maturity period-wise comparison of each mutual fund here. So this is a total comparison of all mutual funds have taken, whether it's a good return, an average, whether it's giving a good return, average return, or a minimum return. So it's just an analysis for you to choose uh, which mutual fund you need for long term or which mutual fund you need for short term. And moving on to the next page, we can see it's a similar comparison that we have done for stocks. It's a comparison between the individual mutual fund and its related index. The index is the market. So how the market performs, how the individual mutual fund performs with comparison to market, whether it is overperforming or underperforming when it's compared to the market. And these are all the financial measures that we use to determine whether it's a good mutual fund or not. And finally, this is the page that is important for an individual investor, where he'll be able to choose an amount, let's say 1 lakh rupees, for a period of 600 days. And I can see how much return this particular mutual fund will give me almost. It's Aditya Birla will give me 3,57,000 rupees if I invest 1 lakh rupees now. And you can see it's similar page that we have done for equity as well. So this is a lump sum calculator, but this SIP calculator is unique to mutual fund, where you can select the number of period that is in months. So let's just say I'm going to invest for 10 months of 40,000 rupees, 10,000 rupees, 10,000 rupees for a period of 10 months. Then I'll be able to generate a return after 10 months. This is the return that I'll get after 10 months. And this is my net return in percentage. That is the rate of return. I can see for different uh, mutual funds as well. So yeah, so that is all about mutual fund. Yeah. So let's move on to bonds. Uh, Most people might not have heard about bonds, like what because equity and mutual funds are more popular investment options when compared to bonds. So I'll just give a brief explanation what bond is. So basically, when a company wants to raise loans, or they have a short term or a long term need, and they need finance, but they don't want to give out their equity or share of ownership. So they issue bonds. So what they do is they issue this instrument to public or private institutions or individual retail investors, and we are able to buy this instrument. So it might be it will have face value, and we are able to buy the number of n number of bonds, and we are able to invest uh, an amount in this instrument, and we'll get a return which is better than FD, but lower than equity or mutual funds. This is because there is a certain safety in the bonds, because bonds are categorized through credit rating by credit rating agencies. So a bond which has a high or a good credit rating will be more safer than a bond which has a lower credit rating. So we'll come to that in the coming slide. So no worries. So that's a intro about bonds. Now let's move on to the first page here. So this is a basic page where you'll be able to see uh, all the details that is available to public for a particular bond. So here I have taken all these bonds for analysis. So if I select a bond, I'll have a credit rating. See, this is the credit rating I mentioned earlier. So I'll have a credit rating, and I have its segment the bond belongs to, what the bond type is, whether it's corporate bond means issued by companies, whereas a government bond will be issued by the state government or central government or even RBI. So you can see the name of the bond and its issue date, its maturity date, its coupon rate. That coupon rate is the return percentage, and its issue size, its code, its IP frequency means the interest payment frequency, and the face value of one bond. Face value is not the uh, amount at which you can buy the bond, but it is the amount at which the interest is calculated. So yeah, more clarity will be given on the coming slides. So here we have included a brief description of each company, which company is issuing the bond. So it's a basic description of that. So I'm moving on to the next report. It's a daily report. It's similar to what we saw in uh, equity and mutual funds. Here we can select a particular bond and see its first you can see the trend line of that bond with its index. So index means market. Bond also has a market. So here you can see the index name. It's Nifty 10-year benchmark GSET. It's a government security benchmark, which is a bond, let's a government bond that has a 10-year maturity. You can see all the bonds are compared uh, with that particular index here, and we can see how it's performing based on how each bond is performing based on the movement of the benchmark or the index. So that is this, and you can see the annual return. This return here means not the coupon rate, but the fluctuations in the market based on which that trade price of a bond is changing. So here, like I mentioned earlier, the face value of a bond is not the price at which you buy the bond; it's a trade price. It's the price at which it's available in the market. So it varies due to market fluctuation, and you can see different bonds are issued at different prices. So this table here also shows the risk at which this bond is trading at. The risk is a measure used to see it's a measure that is related to the fluctuations in the price in each day. And here you can see the volume that it's traded and at what price it's traded. For example, here you can see in March it has the highest volume, but its price is comparatively lower. So, but the highest price here is in August, but comparatively lower volume instead. So we can say that a small number of people influence the price of this particular bond. So that's kind of analysis we can perform in this page. And let's move on to the next page here. Yeah, this is a rating report. So, like I mentioned earlier, all bonds have some kind of rating assigned to them. So, if it's a low risk bond, then most probably the rating would be A, double A, and triple A, A plus, etc. Everything that is above double A would be categorized as a low risk bond. It offers a relatively lesser coupon rate or yield rate, but its risk is much less compared to the other higher risk or medium risk. So you can see which all bonds are giving are low risk bonds here, and which all are in medium risk. So you can see medium risk offers a higher return, and higher risk offers the highest return of interest. So if I select a rating, I can see a brief description about what that rating is from this page. So any doubt regarding the credit rating would be cleared if a person can navigate through this page. So that's it about this page. Let's do a bond comparison here, where we are comparing each uh, bond that we have taken for analysis. We are comparing the daily return and risk of each bond. Here you can see all the green bonds are those bonds where you are able to generate a higher return based on the risk that we are taking. And the red bonds, we are taking a higher risk and generating a lower return. And this is the bond wise coupon rate. You can see India Bull Housing Finance has the highest coupon rate and bond rate, I mean yield rate compared to the others. And this is just a smart narrative that can read through based on what this page has analyzed for us. And finally, we have the index wise rate of return. So we have different index here. Okay, we have the 5-year index, 10-year index, 3-year index, and different index has different rate of return. It's just an informatory visual here, so that's nothing to worry about. And moving on to the next uh, page, we can see, yeah, this is the calculator that we have seen for all other investment options as well. Here you can select a uh, particular bond, and I'm just typing in the amount here. And I can, yeah, if I invest 11,000 rupees, and by the time of maturity, I'll be able to get 24,000 rupees here, and my gain will be around this much percentage. And the annual coupon rate that I will be receiving will be 82 rupees. So it's just a calculator where if I am holding this bond till maturity, how much return I will be getting. So it's the calculator based on uh, each bond maturity of each bond. That is okay. So for the next page, it's a bit unique here. Yeah. So this page is a bit different than the previous one. Here, you are able to select. Yeah, if you are an individual investor who wants to, uh, who doesn't want to hold the bond till maturity, but wants to sell the bond in between in the market. So what? So my investment goal is specific here. So for example, if I am selecting India Housing Board, and India Housing Board only has 2 years to maturity. So I don't want to hold this for 2 years. I'm just selecting and holding it for 1 year. And yeah, similar amount if I'm giving 11,000 as my amount in hand, I'll be able to earn a yield rate of 10%, I mean 11%, and this is my future value that I'll be getting after 1 year. So if I'm holding it till maturity, I'll be getting this figure. So you can see that it works differently for uh, different. So here you can see for rural electrification, the years to maturity is 10, but I am selling it off at end of fifth year. And yeah, so my return would be around 13,000 rupees, 13 and a half. And this is my gain after 5 years. So that is what this page is all about. And the next page is just a country-wise report where I'm comparing each country's inflation with its monthly, weekly, monthly and weekly changes in the yield, as well as the year-on-year comparison. Just an informatory page here that if you want to see at an international level how bond is performing, you can come to this page and choose. Okay, that's all about bonds. That we have is rates and inputs. Rates and inputs are also like shares or stocks which can be traded in the market. It's a kind of equity only. But why we have taken this particular topic is because uh, real estate investment funds and construction domain is not accessible to the normal investors, individual investors, because of lack of bulk funds. So as you know, we need huge amount to invest in real estate projects and construction projects, infrastructure projects. So in the case of REITs and InvITs, that is real estate investment trust and infrastructure investment trust, they collect amount from us and they share their part of ownership, and they with the pool amount or with the pool fund they directly invest in real estate projects and infrastructure projects. So ultimately what happens is all the profits from those projects gets passed through to the individual investors, and the benefit uh, is passed on to these individual investors in form of dividends or capital gains. So moving on to the first page, it's a very similar comparison to what we have seen in all these investment options we have done. The bar uh, represents the volume traded, and the line represents the price movement. And these are all the information that is required for each rate or input that we can see in this slice up here. Moving on to the next page, it's a comparison of each individual stock with the index. That the index we have chosen here is Nifty Realty, which contains the real estate uh, real estate investing companies. It's a list. The list is given here in this table, and these are all the measures that we use to analyze whether an stock is performing overperforming or underperforming when compared to the, the index or the market, or whether it has a good return when compared to its risk. And this chart here is just the comparison of how the volume is different for the market as well as an individual stock. And moving on to the next page, we have the yeah, annual information table, where it's basically a company information chart. It's comparison of information of all the companies that I've selected here, and you can select which period you want to do the comparison. The chart here is a comparison of the market price and dividend yield of all the rates and index, and this is the comparison of the bank balance or cash balance. This chart is the comparison of the PE ratio and the PS ratio of each each stock, and this is the comparison of asset ratio. And this chart here is the comparison of product. So for each visual, you can see a different uh, stock is topping the whole chart. So you can assess the liquidity or the financial liability or any ratio and understand whether it's a good stock. Moving on to the next page, we have a future value calculator. I'm not going to show this again because you have seen in all the other slides, last page slides of each investment option as well. It's just a similar comparison. Can see for all these stocks here, and the expected value calculator. Yeah, it is a bit unique, which we have seen for banks earlier. Here you can select your amount that you have in hand and how much you expect it to grow in future. For example, I have 1,000 and I expect to grow 3,000, grow to 3,500 in a period of maybe 3 years. So this you can see that the highest return is given by the Embassy Office Park, and the maximum return is 13.6. And you can only earn around 2,000 rupees by buying two shares with this amount. So this is the maximum amount of return that you can get. So this is an unexpected, I mean, unrealistic expected rate. So if I'm investing it for maybe 4 years, then yeah, this comes to a closer figure. At least it's coming closer to the figure. And here you can see the expected ROR versus annual ROR comparison with each stock. So that's it about rates and index. And finally, yes, this is what our whole project was about. This is what we have been waiting for, the optimum portfolio generator page. And I have already given a brief explanation about what a portfolio is and what optimum portfolio we're trying to generate. So you saw a lot of investment options in the previous pages, like banks, equity, mutual funds, bonds, rates, and index. So we have selected a top 10 investment options from uh, total top 10 from all the investment options we have seen. So based on that, we have chosen. I'll just show you which one we have chosen here. So if I just go to the next page, you can see this is the code that I've given for each of the investment option I've selected for creating a portfolio. and you can also see the risk level of uh, each investment. So I have taken top 10 from all the investment options. Here you can see I have selected rates, I have selected mutual funds, I have selected banks, I have selected stock, and I have selected bonds as well. So moving back to this page, you can see if I am giving if I have 10,000 rupees with me, and I'm expecting it to grow to 20,000 rupees, and I'm willing to invest for a period of let's say 18 months, that is 1.5 years. What is my expected rate? You can see my expected rate here is 58 percentage. So by creating an optimum portfolio, will I be able to generate a, generate a similar level of uh, return in future? So you can see here that my expected rate is almost 60%, but this particular portfolio here is showing 19,000 rupees here. So this 19,000 rupees is very close to my expected figure. So by investing in EQ1, so EQ1 here is, let's see the code here. EQ1 is Bajaj Auto. So by investing in Bajaj Auto only, you might be able to earn 59 percentage return and close to 20,000 rupees by investing rupees 10,000. So that is, and here you can see if I selected a low risk level, no options is being displayed. And if I selected medium risk, again, no options is displayed. And if I select higher risk, I am getting all the data. So an expected rate of 59% is said to be highly risky, and you might lose a lot of amount, uh, and you might not get the return as you expected. So let's say instead of 18 months, I'm willing to invest it for 48 months. So my expected rate becomes 19%. So here what I can do is, should I really take higher risk to earn a 20,000 rupees return or 19% return? So let's see if I select low risk. Yes. So if I select low risk, I'm getting a portfolio where I'm able to get a very close figure here. So by investing in bond one and equity two, equity three, FP1, by dividing my 10,000 in this proportion, 2,500, 2,500 here, 2,500 here, and on these four investment options, I'll be diversifying my risk exposure, and I'll be able to generate a similar return in the future. So it's a low risk level because I'm investing only 25 percentage on, I mean, almost 50% on equity and other on FD and bond, which is a low risk investment. So instead of taking a higher risk here, I can take a low risk or a medium risk to earn a similar future value. So this is what other investment profiles would show you. Uh, Here, if you are not an educated investor, you might only look into higher risk opportunities. So uh, instead of only for investing in equities or mutual fund, you can diversify and create a portfolio and invest your funds in all these investment options equally, and you'll be able to generate the same amount that you wish to earn in 48 months. So this is the uniqueness of this page. And the next page here is it's for a more educated investor. Let's say I am an investor and I am a bit educated compared to others. So I know where to invest my funds, but I don't know what kind of future value the investment generate. So let's say and I have 10,000 rupees in my hand, and I'm investing for a period of 18 months. So I want to invest this 10,000, not fully on, maybe if I want to only invest in MF2, I'll just select 100% on MF2, and I will click this click this visual here, and you can see that I'll be getting almost 43% return if I'm only investing the whole amount on NFT. Instead, let's just say I want to invest only 25% on NFT, and I'm investing 50% on my FD, and the rest 25% I'm investing on a right embassy office park. So here you can see another investment option is getting generated. Yeah, here you can see I'll be able to get 22% return, almost 12,000 as my future value. So this is all about the investment we call Optimum Portfolio Generator. And thank you for doing this presentation.